So today our group will be analyzing JetBlue's fuel hedging strategy for 2012. We're going to walk through the market conditions leading in, identify which commodities actually moved with jet fuel, and use Excel regression outputs to determine the most effective hedging instrument. Then we will explain the WTI Brent divergence, why some airline hedges failed, and ultimately present our recommended hedge for JetBlue moving forward. To start with some context, 2011 was an extremely volatile year for fuel markets. Jet fuel prices climbed to $3.17 a gallon, the highest since 2008. At the same time, fuel had grown to almost 40% of airline operating expenses, especially heavy for a low-cost carrier like JetBlue. JetBlue alone consumed 525 million gallons in 2011, amounting to over $1.6 billion in fuel costs. And because airlines can't always pass higher prices on to customers without losing demand, this level of volatility becomes a major risk. So going into 2012, hedging wasn't necessarily optional. It was essential to protect margins, stabilize cash flow, and support planning around ticket pricing and scheduling.
Historically, airlines had been using WTI oil futures because they used to track global oil prices closely. But starting in 2010, a massive pipeline bottleneck in Oklahoma caused this oil to pile up locally, which made WTI much cheaper than the Brent crude oil, and the spread reached $20 to $28 per barrel. Jet fuel didn't follow WTI, and it continued to follow Brent and other refined products. And in result of this, jet fuel prices were following Brent, so other airlines were exposed to basis risk as they were hedging with the wrong oil. And this led to large industry losses, with examples here showing Southwest losing $227 million and United losing $56 million. So what commodity does jet fuel actually follow? Jet fuel doesn't move with crude oil directly. It moves with refined products, specifically, in this case, middle distillates. When a barrel of crude oil is refined, it gets split into different products. 47% gasoline, 23% distillates like diesel and heating oil, and only 10% jet fuel. Because heating oil and jet fuel come from the same part of the barrel, their prices move almost identically. That means heating oil reflects real jet fuel price movements while WTI does not. So, as hedging jet fuel with crude oil introduces basis risk, we want to hedge with heating oil as it eliminates it because the two products are chemically and economically linked.
Before deciding how JetBlue should hedge, I started by working with the case's price data in Excel. I converted the crude and product prices from dollars per barrel to dollars per gallon, and then calculated the monthly percentage change for jet fuel, WTI, Brent, and heating oil from 2000 to 2011. Using those percentages changes, I ran some regressions and correlation analysis, and the next few slides are the key results and show which commodity actually tracks jet fuel the best. Here are the main results from my regression analysis using monthly data from 2007 to 2011. I regressed jet fuel prices on each commodity, heating oil, Brent, and WTI. Heating oil has a beta of about 1.01 and an R-squared of 0.96, so it explains 96% of jet fuel's movements and moves almost one for one. The T-stat of 36.96 is very high, which means that this beta relationship is statistically significant. We can be confident this relationship is real and not just random noise. Brent is also strong with an R-squared of 0.85 and a T-stat of 16.8, while WTI is weaker with R-squared of 0.79 and a T-stat of 13.2. So statistically, heating oil is the best hedge, with Brent coming in second and WTI is clearly the worst. Here I zoom in on 2011, which was the most recent data available. It was a stress year when WTI and Brent really diverged. Using just the 2011 monthly data, I calculated correlations between jet fuel and each commodity. Jet fuel stayed very tightly linked to heating oil with a correlation of about 0.98 and to Brent at about 0.94, but the correlation with WTI dropped to about 0.75, which showed that WTI became a much less reliable hedge exactly when JetBlue needed the most protection.
For 2012, our recommendation is to shift the fuel hedging program toward heating oil futures. The data shows heating oil has the strongest correlation with jet fuel price movements and the lowest basis risk among the alternatives we evaluated. That's because both jet fuel and heating oil come from the same middle distillate cut of the refinery slate, so their prices naturally move together much more tightly than crude benchmarks like WTI. Heating oil futures also offer reliable liquidity, meaning we can scale the hedge comfortably without distorting the market. Importantly, the strongest statistical relationship makes this approach much more likely to satisfy the gap hedge effectiveness requirements, reducing the risk of earnings volatility from accounting issues. We're also aligned with broader industry practices. Other major carriers, including Delta and American, have already shifted away from WTI and toward distillate-based hedges for these exact reasons. Overall, moving to heating oil futures gives us a cleaner, more effective, and more defensible hedge for 2012. For the hedge implementation, we'll use NY Harbor heating oil futures as the primary instrument. We recommend hedging the Q1 2012 fuel requirement, about 131 million gallons, and then rolling the position forward each quarter to maintain coverage. Our target hedge ratio is 40 to 50% of expected consumption, with each futures contract representing 42,000 gallons. This translates to roughly 1,250 contracts for a 40% hedge and about 1,560 contracts for 50% coverage. Because the historical hedge ratio is essentially 1-to-1 with a beta of roughly 1.01, sizing the position becomes straightforward. One heating oil contract effectively offsets one contract's worth of jet fuel exposure.
For the side, we're going to talk about the effects on JetBlue fuel if unhedged. So no hedge costs or option premiums. There would be a full benefit if fuel prices end up falling. With that being said, profits are highly exposed if prices end up spiking. There's much greater volatility in earnings and cash flows when we do the unhedged method. Next, we're going to talk about the effects on JetBlue fuel if we do hedge. This would reduce earning volatility when prices end up spiking, if they do. More budget certainty for planning and ticket pricing. The hedge gains would offset higher fuel costs. With that being said, there may be option premiums, and we have to pay them, and we might give up some of our upside if the prices end up falling. So our final recommendation for JetBlue's fuel hedging is we will hedge. We're going to hedge about 40 to 50% of our expected jet fuel consumption. We're going to use the New York Harbor heating oil as our primary hedging instrument. Next, we plan to implement a 12-month rolling hedge program. And finally, we're going to use collars to balance protection and our hedge cost.
Thank you for tuning in.